So, there's this business owner who tried to write off a $5,000 luxury gym membership as a business expense. Not equipment, not uniforms, not something required to do the job. A luxury gym, full service, high-end, the kind of place with spa amenities and towel service.
Wait, that doesn't work?
Here was his reasoning, and this is real. I need to stay in shape for client meetings. That was the justification. That staying physically fit made him more effective in business, more present, more professional.
I mean, that kind of makes sense though.
And that's exactly why this kind of expense gets people into trouble. Because it sounds reasonable until you apply IRS logic. The IRS literally replied, so by that logic, should we also approve your personal trainer, nutritionist, and Botox appointments?
Oh, snap.
And that response tells you how the IRS actually evaluates expenses. Today, we're breaking down the wildest things business owners have actually tried to expense, and more importantly, why the IRS said no. Because once you understand the why, the outcomes stop being surprising. Before we roast anyone else, quick question. Have you ever written off Netflix as competitor research? Put your entire family's phone plan under business communications? Or claimed your daily commute as business mileage? Not once, not as a mistake, but as something that felt reasonable at the time.
I'm gonna take the fifth on that one.
If you're feeling personally attacked, good. That means this video applies to you. Because most audit issues don't start with bad intentions. They start with assumptions. And here's the part most people don't realize. The IRS has been using automated data matching and pattern analysis for years. Long before AI became a buzzword. Long before people thought the IRS was behind on technology. And what you think is clever, what feels like a gray area, they flagged it back in 2019, sometimes earlier. Not because of one expense, but because of a pattern. But because your overall pattern stopped making sense. Let's start with the number one audit trigger we see every single year. Not complicated tax shelters, not offshore accounts, not aggressive deductions. Disappearing cash. Cash that exists in real life, but quietly vanishes on the tax return.
So I run a cash-heavy business. Customers pay cash. I just,
Forget to report some of it because it doesn't feel traceable, because it doesn't show up on a 1099, because it feels invisible.
I wouldn't say forget, more like strategically overlook.
Right. The IRS calls that tax evasion. Different word, same math. Intent doesn't change the outcome. To be clear, not every mistake is fraud, but repeated patterns without correction are treated very differently. The dollars are either reported or they aren't. A local restaurant reported $80,000 in revenue for the year. On its own, that number doesn't raise alarms. But then the expenses told a different story. $120,000 in payroll, $60,000 in rent and utilities, $150,000 in food costs. Those numbers don't exist in isolation. They have to be funded by something.
Wait, that's already more than double the revenue.
Exactly. And that's why the IRS response was, so, are you running a charity? Should we send you a donation? Because from the IRS's perspective, the math doesn't just look wrong, it looks impossible. This happens every single tax season. And here's the key part most people miss. The IRS doesn't need a human agent sitting there with a calculator to catch this. They compare your numbers to industry benchmarks, by business type, by zip code, by region. Restaurants in your area tend to report 30 to 50% cash. If you report 5%, the system doesn't see creativity. It sees a pattern break.
So it's not even people reviewing this. It's just systems?
Yup, and those systems have very long memories. They don't just look at 1 year, they look at trends. If your cash percentage goes from 45% to 50% to suddenly 10%, the system doesn't think, oh wow, amazing technology adoption. It thinks, something doesn't add up. And once that flag is raised, a human eventually steps in. Cash itself isn't illegal. Inconsistency is. Let's run through a few real-world classics. These aren't edge cases. These aren't rare mistakes. These show up in audits every single year. First case, nail salon. The salon reported $200,000 in cash expenses. but only $30,000 in cash revenue. From the IRS's perspective, that's not aggressive. That's illogical, because cash doesn't operate in a vacuum. If you're spending it, it had to come from somewhere. The IRS response: does cash just appear out of thin air for you? Second case, convenience store. The owner claimed the business was mostly card payments, very little cash income reported. So the IRS checked ATM withdrawal records. $5,000 withdrawn every single week for 52 weeks. That's $260,000 in cash moving out of the account. At that point, the question isn't technical, it's practical. So where did it all go? If cash is leaving the business, it should show up somewhere in the story. Third case, barbershop reported income, $50,000. But social media told a different story. Instagram showed a Tesla, a $200,000 house down payment, luxury vacations. The IRS response: either you're the world's most successful barber, or the math isn't mathing. And that's not sarcasm. That's an audit conclusion. The lesson here isn't don't have cash. Cash businesses exist. They're legal. They're normal. The lesson is this: your entire financial story has to make sense together. Income, spending, lifestyle, assets. If one part tells a different story than the rest, the IRS doesn't debate it. They investigate it. Red flag number 2, treating your business like a personal ATM. Not maliciously, not recklessly, but casually. Money goes out when you need it. No pause, no label, no paperwork in the moment.
But it is my company. Can't I just take money when I need it?
You can, but you have to be very clear what that money is, because the IRS doesn't see my money. They see categories, and each category triggers very different tax rules, reporting requirements, and audit treatment. First, salary. Second, loan. Third, reimbursement. Fourth, distribution. Lastly, bonus. Same cash leaving the account. Completely different tax consequences depending on the label. And the IRS expects that label to be decided before the money moves, not after. Real case, same owner, same company, same tax year, 5 withdrawals, and each one was labeled differently. One was called payroll, one was called a loan, one was marked reimbursement, one was treated as a distribution, one was labeled a bonus. No consistent pattern, no supporting documentation tying the label to the transaction. The IRS question was simple: so which one is it? Or are we just picking tax terms at random? Because from the IRS's perspective, inconsistency isn't flexibility. It's a red flag.
Money's money, though, right?
Absolutely not. Here's the IRS rule in plain English. They don't care what you call it. They care whether the paperwork matches the label. Loans require loan documents. Payroll requires payroll filings. Reimbursements require accountable plan rules. Distributions require ownership support. When money moves without consistency, documentation, or a clear framework, that's when audits escalate. Not because the IRS assumes fraud, but because the story stopped making sense. The IRS's 3 favorite words: first, consistency; second, documentation; third, clarity. Those 3 concepts show up in almost every audit decision. If your books don't tell a clear, consistent story, the IRS will rewrite it for you. And they'll rewrite it using their assumptions, their benchmarks, and their documentation standards.
And they're way less generous auditors.
Exactly. Because once the IRS steps in, the question isn't how reasonable the expense felt. It's whether the story holds together, line by line. If any of these examples felt uncomfortably familiar, that's usually the moment to fix things, not ignore them.